Then there's types of sales. When you think about sales, you have annuities, and generally that's a private annuity. We'll talk more about it. And then there are installment sales in which you have a regular installment sale, or what's called a SCIN, a SKIN, a self-canceling installment note. And then you have a sell and leaseback. And I'm going to focus primarily, incidentally, on the sell and leaseback and not the gift leaseback. But if you get one, you'll at least probably understand the fundamentals of the other. Now, having talked to you about that list of items, now let me discuss a category or a type of giving that potentially straddles these categories, and it's an issue that the IRS focuses on a great deal, and you need to be aware of this when you're thinking about how should I plan for the future. Many people like to do what's called a split interest gift, a split interest transfer. All that's saying is that the donor wants to have the best of all worlds, right? Wouldn't you prefer to be able to keep the possession and control and enjoyment of an asset, and at the same time transfer it out of your estate? That would be a nice trick. And if you could do a transfer in which you retained a life estate, then that means that at your death, the life estate, meaning the right to enjoy something for a period of years or for the balance of your life, by definition it's gone and has no value at the moment that you die, right? So what's left is this interest that you transferred. Now, the interest that you transferred, you tried to value down as much as you could. So the objective when you're engaged in that sort of game, we'll call it, is your objective is to transfer as little as possible for purposes of gift tax issues. So say that you have an asset that's worth $10 million, and you want to peel away for the balance of your life the possession and enjoyment of that. Maybe it's that you want to take income from it. Maybe it's you just want to possess it. In whatever sense that you want to retain control of that, that's going to dramatically reduce the value of that asset. And that's kind of what you want to achieve here. So you're having your proverbial cake and eating it too. You're making this transfer in which the value of the transfer you've diluted and diminished as much as you could, so that the gift tax issue may be diminished so much that it goes away, depending on the value of the asset and your remaining exemption, etc. Meanwhile, you're taking on an asset that will disappear by definition at the date of your death. You've worded it that way. So you can, as you might imagine, the IRS is going to scrutinize this sort of transaction. The IRS is not likely to permit this to happen without their vehement protest. And their vehement protest has resulted in legislation that very much restricts your capability of doing this. And the way that this has been restricted dramatically, a couple ways. One is that if you die with this possession and control, then you are looking at something we've talked about before, and I don't want to get too technical on here, but in some cases it's probably helpful to give you a statute. If nothing else, you'll have reference to it when it's referred to later by other professionals that are helping you. And for those of you who are inclined to research, then you can research this section. There's section 2036 through 2038, which focuses on any assets that at the date of your death you had any control over, then it sucks it back into your estate entirely. Now, that wouldn't pick up a life estate. A life estate, by definition, you have no control of. But any other assets that you're hanging on to in some way, even if it's a secured interest, if for example, you've sold it and you've taken back a note with a secured interest on it, then that may very well fail to get over the hurdle of 2036. So 2036 through section 2038, these are critical, and what they do is, their objective is to capture anything that at the moment of your death you have control over. But more effective than that is another showstopper that Congress passed to get at this split interest transfer tactic. And that's in section 2702. And 2702, and you can ignore it, those of you who are not inclined to pay attention to these codes, I don't blame you. Just remember what this section says. It says that when you make transfers to family members, and it defines who those are: spouse, siblings, children. And it picks up a pretty broad definition of family. So that if you make a transfer to those, here's what it assumes. It's called the zero valuation rule. What it assumes is that the value of what you retain is zero. Now remember the rules of this game. The rules of this game is to give what you retain, oddly enough, as much value as possible if you've designed it to expire prior to the date of your death or at your death. Then you want to have the valuation of what you transfer as a result to be as little as possible. The way this math is done is the code will often calculate what is the value of the interest that you're retaining. And there are tables. The Internal Revenue Code has tables by which they look at what you've retained. If it's a stream of income, they'll take that and calculate a present value. They prescribe life expectancies. They prescribe interest rates that you use to calculate present values. And incidentally, any calculator, any business calculator will calculate a present value. So I know some of you, when you hear that phrase, you're thinking, gee, what does that mean? And maybe at this point I've gotten a little over the head of some of you, so just bear with me. We'll eventually walk into more shallow waters. But in any case, they prescribe a method by which you calculate the value of the interest that you're retaining. You subtract that from the total value of the asset, and then that's the interest that you've conveyed. Now, some people do that calculation in reverse, and it can be, and it does produce different numbers. But it's important to understand that what the IRS has done here is tried to plug this hole in estate planning strategies, this hole from their perspective that permits people and families to transfer substantial portions of their wealth with very little or no gift or estate tax. And the way they've plugged it is that they've just stated across the board that if you're making a transaction, if there is a transaction between the parties in which you're retaining this reversion or this retained interest. If you have this retained interest, then the effect of that is that your reversion interest, that value is zero. So it means that the gift of the property is its full fair market value. So you can see that kind of the attraction of your strategy goes away to a great extent. To some of you it would go away entirely. It means that you can no longer have that advantage of eating your cake and having it too. But let me hurry and add this. Even with that provision, it still doesn't mean that it's necessarily a bad idea. You're still getting an advantage, a benefit that we've talked about before on this show, and we'll talk about more. Remember that concept of the estate freeze, the asset freeze, value freezing it's sometimes called. That's the whole idea that you know that this asset is going to appreciate dramatically in the future. You're planning 10 years or more before your death, and you want to get it out of your estate now so that all that appreciation will not come through your estate. And of course this is probably based on the assumption that the capital gains advantage or the stepped-up basis advantage is going to go away. We don't know that, but some people plan with that expectation. In any case, it may still make sense to do the sort of split interest transfer that I just described, where you create a grantor retained income trust called a GRIT, G-R-I-T. That may be a transfer in which you transfer an asset and you have the income continue to flow to you for the balance of your life. The asset has been moved to an irrevocable trust. That would still have value to you if in fact it wasn't in your estate, and all that appreciation is instead something that is owned by this irrevocable trust. And remember, there are other prongs that you have to meet so it doesn't get sucked back into your estate. But subject to that, it may still make sense to do these transfers during your lifetime, in which you pay the gift tax, whatever it is, because you know that's better than paying the estate tax down the road. So where we go from here is I want to talk about sales, and I want to talk a little bit more about donations. But we're out of time here, so I want to conclude this segment. Then I'm going to pick up in our next segment and talk specifically about sales. Okay? Look forward to talking to you. I hope this has been useful. This is Joe Cordell, another episode of Cash Counsel. Take care.